So that's the, now you know the banker acceptance. Sorry, there was some problem. So you can hear me now. Okay, so I'm going to share the screen. So the banker acceptance, that mostly when we are doing the international trade, so we use banker acceptance where the bank gonna provide us the guarantee, so that we can do the international trade to another firm in another country. It has a high tradable secondary market. And then repurchase agreement, as I told you, that it's like after certain time, first I'm selling the security to you, or I'm any like security to you, and then I'm at the same time I'm also making an agreement that after certain time I'm gonna buy back my own security from you with certain price, and that price should be having an incentive in it. Mostly it's up to 1 year. Remember, the bankers acceptance is up to 6 months. You cannot have like more than 6 month bankers acceptance. So any international trade can is possible within 6 months, right? So then it can help the importer firm to take the banker acceptance from their bank. So it's up to 1 year. It's issued by the business firms or institutions. Any private people, they can't do that. Me and you are not gonna take part in this activity. It is being invested. So other firms and institutions, they buy it. Why? Again, based on its maturity. The repurchase agreement, which maturity is up to 1 year, is mostly issued and invested by business firms, but also financial institutions. Though it's a short-term security, but the repurchase can be only done on a specific date and price. You have to, within this, it's up to 1 year, but you need to define the date exactly,
Oh,
price on that date. So that's the main difference of the repurchase agreement, that it is but the maturity date is specified. Usually T-bills, you can go anytime. Banker acceptance up to 6 months, you can avail anytime, right? And you can change these instrument into liquidity, into cash. So it's a kind of a repurchase agreement. It's kind of a mortgage. It has no secondary market because the date is specified, so it's not tradable, right? And similarly, like last, we have federal funds. In US, it's really common. Its maturity is up to 1 week. And remember, it's from one depository institution to another depository institution. Federal funds are also having no secondary market. So these are short-term loan up to 1 week by one depository institution to another. For example, let's say I ask you to lend me 100 RMB, or one of your friend asks you to lend him or her 100 RMB and and he or she promises to return back the money within 5 days. So he or she needs the money in very short interval of time. So you're gonna give it because you are you're the classmates, right? So that's how the depository institutions, they help each other by issuing the federal funds. Now, so this is a brief overview of financial money market. Can you ask other students to join this session, because I can see that suddenly a lot of students, because of their that